A hiring zero's killer hook. Stop the scroll. I called it. 3 weeks ago, I told you silver would test $85, $90 after the February massacre. And here we are at $87, 84. But here's what nobody's talking about. While the paper price recovered 10% overnight, physical silver has completely vanished. I'm talking zero inventory at the Royal Canadian Mint. Zero at Perth Mint. SD bullion down to 300 units across their entire catalog. And in Shanghai, dealers are paying $8 over spot just to source metal that doesn't exist. So the question that is going to make or break your portfolio in the next 30 days is this. Is $89 silver the bottom of the greatest buying opportunity in a decade? Or are we about to retest $66 and watch retail investors get absolutely destroyed? Because what I'm about to show you, using real dealer data, COMEX inventory numbers, and physical premium charts, will tell you exactly which scenario is playing out right now. Hour 30. Market now. Facts. Plus data. The recovery that nobody trusts. All right, let's cut through the noise. Here are the facts as of February 4th, 2026. Silver closed yesterday at $87.84 per ounce. That's up 10% from Monday's low of $81.67, and it represents a massive bounce from what was the most violent crash in 46 years. Let me paint the picture of what just happened. January 27th. Silver hits $122 per ounce, an all-time high. January 30th, 26% single-day crash to 89, worst drop since 1980. February 2nd, another 6% drop to 81.67. February 4th, recovery to 87.84. In 5 trading days, silver went from $122 to $81 and back to 88. That's a 41 collapse followed by a 7 recovery. This isn't a market, it's a battlefield. Now here's what makes this different from every other silver correction you've ever seen. The physical market is completely decoupled from paper prices. Let me show you the evidence. COMEX registered inventories. Down 70% since 2020. Currently sitting around 30 million ounces. At current demand, that's less than 45 days of global supply. LBMA, London Vaults. Down 40% since 2021. Fastest depletion in recorded history. Shanghai silver inventories. Lowest level in a decade. Physical premiums, $8 per ounce over spot. That's a 9% premium just to get metal. But here's where it gets insane. Retail dealer inventory crisis. Royal Canadian Mint, out of stock on all major products. Perth Mint, out of stock on silver kangaroos in most bars. SD bullion, 2,300 units left across their entire catalog. This is a dealer that normally stocks millions of ounces. Costco, zero silver or gold at any Ontario location. Vietnam dealers can't even source raw material to mint new coins. And the premiums? Absolutely bananas. UAE, Dubai. 40% premiums over spot. Japan, Mercari secondary market. 60% premiums in China, Shanghai physical. 40 to 80% premiums depending on form. United States, 1Oz coins, 12-20% premiums. Mike Maloney, one of the most respected voices in precious metals, just released a video where he used the term unobtainium to describe what's happening. He coined that phrase in 2008 during the global financial crisis when physical silver completely disappeared from the market. Folks, we are back in that territory. The iShares Silver Trust, SLV, borrowing fees for short positions just hit 10%. Zero shares available to short. That means hedge funds and institutions are desperate to cover positions, but they can't find the metal. So release rates, the cost to borrow silver for delivery, have exploded from a normal 0.3 to 0.5% to 8% annualized. Why would anyone pay 8% just to borrow silver? Because not having silver is more expensive than paying those insane rates. This is what a physical squeeze looks like, people. Not the 2021 Reddit rally, not the Hunt brothers manipulation in 1980. This is industrial users, retail investors, and institutions all competing for metal that doesn't exist in sufficient quantities. Silver just crashed 27% in a single day after hitting $122 per ounce, the most violent move since 1980. Let's talk facts, real numbers, no hype. As of February 4th, 2026, literally yesterday, silver is trading at $87.84 per ounce. Sounds good, right? Well, 3 days ago, it was at $122. That's a 27% single-day massacre on January 30th, the largest one-day collapse in modern history. Gold, currently sitting around $4,600 per ounce, down from an all-time high of $5,600 just last week. Now here's where it gets interesting. Over the past year, silver is still up 171%. Gold is up 70%. These aren't corrections. This is a market being ripped apart by forces most investors don't even know exist. The iShares Silver Trust, ticker SLV, just recorded $171 million in inflows in a single day on January 27th. That's double the previous record from the 2021 silver squeeze. Retail investors poured $921.8 million into silver ETFs in just 1 month. But here's the kicker. COMEX registered silver inventories are down 70% since 2020. London vaults, down 40%. At current consumption rates, some industrial regions have less than 45 days of accessible silver. This isn't a normal correction. This is a liquidity crisis disguised as a price crash. Now, most YouTube finance channels are going to tell you one of 3 things. Option 1, silver is dead. Get out now, it's a bubble. Option 2, buy the dip. This is your last chance before $200 silver. Option 3, the Fed did it. Kevin Warsh's nomination crashed the market. And you know what? They're all missing the real story. Yes, Trump's nomination of Kevin Warsh as Fed chair on January 30th triggered the crash. He's seen as more hawkish, which strengthened the dollar. Yes, CME raised margin requirements from $22,000 to $25,000 per contract, forcing massive liquidations. Yes, this looks like a classic crowded trade unwinding, but none of those YouTubers are talking about China. Because while everyone's focused on the price, China is focused on the metal itself. Here's what your favorite finance influencers aren't showing you. China's not trading silver, they're weaponizing it. All right, let's break down China's 7-piece precious metals domination strategy. This is happening right now, not theory, not speculation, documented policy. Scorsese are piece number 1, massive gold accumulation. China's gold reserves surged from 2,110 tons in early 2023 to 306.32 tons as of January 2026. That's 14 consecutive months of purchases by the People's Bank of China. That's 319 worth $45 billion in gold reserves. And that's just what they admit to owning. The real number? Analysts estimate China holds double that in undisclosed reserves. Goldman Sachs predicts gold will hit $4,900 per ounce by end of 2026, driven primarily by central bank buying. And China is buying 23.4% of all global central bank gold purchases. As of 2024, China held approximately 70,000 metric tons of silver reserves. But here's the genius move. They're buying unrefined silver concentrate. Why? Because it doesn't show up in official reserve numbers. It's classified as industrial inventory. This is the same playbook they used for rare earths. Build massive strategic stockpiles quietly, then restrict exports. Fuck. Peace. For 3, export licensing system, the game changer. January the 1st, 2026. China implements the most aggressive silver export controls in history. Only 44 state-approved entities can export silver now. That's it. This replaced the old quota system and effectively restricts 60-70% of global silver supply to domestic use only. When this policy went live, silver was trading at $84. Within 3 weeks, it hit $120. Coincidence? I don't think so. Peace. Target 4. Industrial demand monopoly. Here's why this matters. China produces over 80% of global solar panels. Those panels use TOPCon technology, which requires 50% more silver than older models. AI data centers? China's building them at breakneck speed. Modern AI servers require 3 times the silver of traditional servers for thermal management and high-speed data transmission. Electric vehicles, 5G infrastructure, high-efficiency semiconductors. China is the dominant player in every single silver-intensive technology. They're not just controlling supply, they control demand too. Peace. Number 5. De-dollarization agenda. Gold's share of China. Its foreign exchange reserves jumped from 5.5% in December 2024 to 8.5% in December 2025 in 1 year. This isn't portfolio diversification. This is preparation for a post-dollar world. China is testing UN gold fixed exchange rates. They're expanding the CIPS payment system as a direct alternative to SWIFT. The Belt and Road Initiative now offers precious metals-backed trade financing. When the next currency crisis hits, China will have the physical backing to survive. Will the dollar? Peace. Number 6. Supply chain control. Here's a stat that should terrify Western policymakers. India's rapid solar manufacturing expansion, driven by government subsidies, is now competing with China for silver supply. The global silver deficit in 2025, 230 million ounces. That's equivalent to the entire annual output of Mexico, the world's largest silver producer. China's strategy is simple. Lock down supply now while prices are volatile. Secure domestic industrial needs first, and let the rest of the world fight over the scraps. Unlike the 2021 Wall Street silver movement, which was retail-driven speculation, the 2026 squeeze is driven by physical scarcity. COMEX registered inventories in the U.S. are down 70% since 2020. Shanghai inventories are at their lowest level in a decade. Physical silver in Shanghai is trading at premiums of 40% over spot prices. When you can't get physical delivery, paper contracts become worthless. In China, they've been taking physical delivery for years. The genius of China's strategy is this. They bought when prices were low, stockpiled quietly, then activated export controls just as industrial demand exploded. It's the perfect economic trap, and the West walked right into it. Now, I'm not here to sell you opium. Let's talk about the real risks that could derail this entire thesis. Kevin Warsh's nomination as Fed chair changes everything. He's seen as more hawkish than previous candidates. If he raises rates aggressively and strengthens the dollar, precious metals could face sustained pressure. Real yields rising historically cools gold and silver momentum, even temporarily. At 110 plus per ounce, industrial users are desperate to find alternatives. Tesla, Apple, major electronics manufacturers, silver is no longer a rounding error in their cost structure. If they successfully develop silver-free or silver-reduced technologies, demand could collapse. High-end AI applications seem immune to substitution, but consumer electronics, that's vulnerable. At triple-digit prices, urban mining, recovering silver from discarded electronics, becomes highly profitable. First Majestic Silver and other miners might actually start competing with recycling operations. This could add significant supply back to the market, though it takes time to scale. Analysts like Marko Kolanovic and Peter Brandt have warned about parallels to the 1980 Hunt Brothers Silver Corner attempt that ended in catastrophic losses. The difference? 1980 was driven by a single family trying to corner the market. 2026 is driven by genuine industrial scarcity and thousands of individual actors. But markets can still overshoot, and this might be the mother of all overshoots. Here's the thing. We don't actually know China's true gold and silver holdings. Their reporting is notoriously opaque. What if they've been overstating reserves? What if they're about to dump metal to crash prices and buy back cheaper? It's happened with other commodities. China plays 4D chess, while the West plays checkers. Our Shast. Risk. Wersix. COMEX rule changes. The CME has already raised margin requirements twice in 2 months. They could implement position limits, force liquidations, or even suspend trading if things get too chaotic. When regulators panic, they change the rules mid-game. Just ask the Hunt brothers. CEO orders. Risk. Garner 7. The crash we just saw. Let's be honest. A 27% single-day drop is not normal. That's liquidity event territory. That's forced selling cascade territory. If you were overleveraged in futures contracts, you got annihilated last week. Even if the long-term thesis is bullish, short-term volatility can wipe out accounts before you're proven right. The market can stay irrational longer than you can stay solvent, especially in precious metals. So here's what you need to have on your radar 24/7 if you're playing this market. Tyrosarumbat. Indicator. Merger 1. COMEX inventory levels. Watch COMEX registered silver inventories like a hawk. If they drop below 25 million ounces, we're in potential delivery failure territory. That could trigger a vertical price spike that makes the January rally look tame. Current level, approximately 30 million ounces. Borderline critical. Square noir trace. Indicator. Number 2. China export license. Data. Track how many companies China actually allows to export silver each month. If that number drops below 44, or if export volumes crater, it's game over for industrial users who depend on Chinese supply. Indicator. Round 3, gold to silver ratio. This collapsed from 101 to 51 during the rally. Right now, it's back around 53:1 after the crash. Historically, when this ratio compresses below 41, silver massively outperforms gold. If it widens back above 81, silver is probably overvalued relative to gold. Prowess. Indicator, number 4, ETF flows. The iShares Silver Trust, SLV, just hit 169 consecutive days of positive inflows. That's unprecedented. But watch for the first negative flow day. When retail starts selling, it could accelerate fast. Conversely, if inflows accelerate after this crash, it confirms retail is treating silver as a core macro asset, not a meme trade. In Shanghai, physical silver is trading 40% above spot prices. In the US, premiums on coins and bars are 15-20% above spot. If those premiums widen, it means the physical squeeze is intensifying. If they narrow, it means supply is loosening. China's solar manufacturing data comes out monthly. Solar accounts for 15-20% of global silver demand now. If Chinese solar production accelerates, silver demand will surge. If it slows, unlikely with China's green energy mandates, it could ease pressure. Every word Kevin Warsh says after confirmation matters. Hawkish, dollar strength, precious metals pressure. Dovish, dollar weakness, dark precious metals rally. The February 2026 crash was triggered by his nomination. Imagine what his actual policy decisions will do. If the People's Bank of China stops its 14-month gold buying streak, that's a major bearish signal. It could mean they're fully positioned and about to let prices fall. If they accelerate purchases, it confirms they're preparing for a major dollar crisis. Any headline about Tesla, Apple, or major manufacturers successfully reducing silver content in products is bearish. Watch tech company earnings calls for mentions of material cost reduction initiatives. Indicator 10. Mining production reports. New silver mine supply won't hit the market until 2027-2028 at the earliest. But watch for announcements of new projects, especially from Mexico, Peru, and China. First Majestic Silver, AG, Kerr Mining, CDE, and other pure-play silver miners are the stocks to watch. If their production increases ahead of schedule, it could ease the squeeze. All right, let's bring this home. Here's what we know for a fact. 1. Silver has gained 171% over the past year, despite a historic 27% crash last week. 2. China has accumulated 2,306.32 tons of gold and an estimated 70,000 metric tons of silver. 3. As of January 1st, 2026, China restricts 60-70% of global silver supply through export licensing. 4. COMEX silver inventories are down 70% since 2020. Physical shortages are real. 5. Industrial demand from solar, AI, and EVs is inelastic. You can't build these technologies without silver. 6. The gold to silver ratio collapsed from 101 to 50.1, signaling silver is being re-rated as a strategic asset. 7. Retail investors are treating silver as a core macro asset, not just a speculative play. Here's what I believe. Based on the evidence, China didn't just stumble into this position. This is a multi-year strategy to de-dollarize their economy, secure critical industrial materials, gain geopolitical leverage over the West, position for the next global currency crisis. The January 2026 squeeze wasn't a bubble, it was a preview, the February crash. That was leverage unwinding in margin calls, not a fundamental breakdown of the thesis. The real move might still be ahead of us. But here's my warning. This market is not for the faint of heart. We're talking about 27% single-day moves. We're talking about forced liquidations. We're talking about regulators changing rules mid-game. If you're going to play this, you need to size positions appropriately, use physical metal or fully allocated ETFs, not futures, have a long time horizon, accept extreme volatility, never use leverage you can't afford to lose. Now, I want to hear from you. Drop a comment with your silver price target for the end of 2026. Are we going to see $200, back to $50, consolidation around $100? And more importantly, do you think China's 7P strategy is genius or reckless? If you found this analysis valuable, smash that like button. It tells YouTube to show this video to more people who need to understand what's really happening in precious metals. And subscribe if you want data-driven financial analysis without the hype. Just facts, research, and honest assessments. I'll see you in the next one. Stay sharp, stay informed, and whatever you do, don't let mainstream narratives blind you to the biggest wealth transfer of the decade. This is just the beginning.